The S&P 500 has been on a rally in the past few months, and it's very close to a new all-time high. In fact, the S&P 500 Equal Weight Index has already hit a new high. This is a quick turnaround from October 2023, where the majority of stocks were falling. Now, I'm based in the UK, and many of you who watch my videos are from the UK too. But I think it's important that we talk about the outlook for the US stock market and what's been driving this recent performance, because most of us probably have at least 60% of our portfolio invested there. What the new highs for the equal weight S&P 500 show is that this rally has not been driven only by the AI stocks. It's actually much broader, with small companies also outperforming. Research from Morgan Stanley shows that 78% of the S&P 500 stocks were outperforming lately, matching the highest levels of this year. This chart shows that the best performing stocks in the S&P 500 in the past month were no longer the AI stocks, although they did continue to rise. So the fact that a larger number of stocks are powering this positive market performance is a good sign. It indicates a healthier market rally that doesn't center around only 10 to 20 stocks. For many analysts, this broader market performance suggests that this could be the sign of a sustainable and prolonged rally. The key will be a continuation of the current trend, which has seen movement from the 2023 leading sectors like technology, communication services, and consumer discretionary into areas like financials, industrials, and real estate, which were among the best performance in the S&P 500 in the past month. If these parts of the market keep going up and the main AI stocks don't drop suddenly, then the market rally might be very promising. However, analysts argue that there was no obvious reason for this recent strong market performance from a macro point of view, nor from the perspective of valuations either. This suggests that the market rally centers around two things: interest rates and investor sentiment. The reality is that this recent market action seems to be based on the expectation that the US Central Bank, the Federal Reserve, will cut interest rates in early 2024. This could happen if US inflation keeps slowing, or the unemployment rate rises, or if anything else happens that might cause the Fed to lower the cost of money. At the same time, market strategists warn that this current rally could mean stocks are getting overbought, and raises some concern that the gains achieved in just 5 weeks may require some payback early next year. If you think about it, since the COVID-19 pandemic, we've seen a tendency among new investors to overbuy and oversell stocks pretty quickly, especially when people are feeling very negative or positive about the market. Now, we'll look shortly at how much impact we, retail investors, actually have on the movement of the market. But first, I want to talk about the possibility of interest rates not going down as expected. What if they don't fall? In the end, all the Fed has done is write down that they're anticipating cutting rates in 2024, not that they definitely will. So market expectations for multiple rate cuts sooner than later are dynamic and perhaps misguided. If the decline in interest rates, which is already baked into stock prices, doesn't happen as expected, then stock prices will likely fall. Don't get me wrong, they're likely to continue rising in 2024, but a temporary pullback isn't out of the question. If the market gives up on the idea of rate cuts coming within a month or two, stocks could indeed pull back. But then again, this would mean the interest rate pause remaining in place, which would be positive for stocks over a longer time horizon. Because a Fed pause, which we're seeing now, has historically been very good for stock prices. Can the actions in the past months of regular investors like you and me explain the recent stock market performance? This chart shows the relationship between how investors invest their money and the average stock market performance over the 2008 to 2023 period. What it tells us is that when regular investors are positive about stocks and keep putting more money into them, on average the market tends to see better performance compared to institutional investors. Stock market performance reaches approximately 25% per year on average when retail investors keep investing more money in stocks. Comparing these figures from 2008 to 2023 and from 2020 to 2023, it seems like the influence of regular investors on the market has nearly doubled. So could this pattern of retail investors flocking into the markets due to sentiment lead to consistently higher returns in the long run? Well, that's less clear. This chart shows that after a positive change in investor positioning towards stocks, the average performance in the week following doesn't show show a clear trend. Specifically, when regular investors increase their exposure to stocks, it doesn't reliably result in future gains. The historical averages suggest that the performance is close to zero in the period following this positive equity positioning. In contrast, institutional investors like hedge funds show a significant average performance increase of nearly 6% in the week after they increase their exposure to stocks. This implies that institutional investors play a more substantial role in driving longer periods of market growth. So while regular investors may contribute to the overall market sentiment and momentum, their impact is mostly coincidental. In simple terms, although the recent stock market surge was mainly due to regular investors changing how they invest, their influence on markets typically doesn't last very long. Now, all this noise shouldn't really matter to us long-term investors, but I think it's important to stay up to date with what's happening in the short term so that we don't react impulsively. This being said, the real question is this: can the S&P 500 continue to deliver the 10% annual average returns that we've seen in the past 50 years? Check out this video next to find out how different factors, such as a decline in US population growth, may have a negative impact on the future stock market returns.